let's now welcome on board and talk about what's happening with the state of the economy, not just for India, but the world. We've got Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley, joining in on the show right now. Jonathan, hi, good to have you on the show. Day 2 of your conference, right? Tell me what's the chatter about India and all the uncertainties in the world like at the conference?
Well, I was last here in January, and at that point I think there was a debate both here in India and globally about the cyclical slowdown that had been going on in India in the second half of last calendar year. But actually, coming back here for this event, it's very obvious that the economy has picked back up again. I mean, we just printed 7.4% in the most recent quarter for GDP. And many other micro indicators suggest the economy is picking up. For example, GST revenue being up sort of mid-teens year on year. So we know that there was easing of monetary and fiscal policy, and it looks like the Indian economy is kind of moving ahead very strongly. And it's likely to be by far the strongest GDP growth of the major economies in the world this year.
Jonathan, what about the entire construct for emerging markets? Dollar is weak, bond yields globally are at 4.5. Is there enough and more technical and macro factors at play which will drive emerging flows into emerging markets? What's your view there?
Well, again, I would emphasize that India is quite different from other emerging markets. For example, we do expect China growth to decelerate this year, and the US and China are engaged in an unprecedented conflict over trade. We also think that, for example, markets like Korea and Taiwan will have a semiconductor cycle to contend with. But there is a group, India is not unique, there are other parts of Latin America and EMEA and Southeast Asia where this dollar weakening that you mentioned is unlocking a quite different cycle from what we've seen in the past. As portfolio capital is moving away to some extent from the US, we at Morgan Stanley do expect the US dollar to be weakening throughout this year. We think on the DXY measure it'll end up below 90. And that produces good things. It gives monetary policy autonomy, for example, to a country like India. So the RBI is able to cut interest rates, even whilst the Federal Reserve is actually on hold. So that's a key positive feature.
Jonathan, the valuations in India, for the longest time, everyone has argued they are expensive and they're above the mean. But given the growth construct which you just outlined and what Morgan Stanley has been outlining, how long do you think investors or global investors will disregard this?
Well, India's been outperforming other emerging markets quite dramatically for 4 or 5 years now, really, since the height of the COVID pandemic. And that's to do with superior earnings growth. It's able to compound earnings per share, MSCI India, around 12% per annum, way above other emerging markets. So you're not going to buy that economic and earnings performance cheaply. You're right that actually if you look at dedicated EM funds, even though India's outperformance and the issuance that we've had in primary and secondary mean that its share in the EM index is going up, EM dedicated active fund managers are slightly underweight the market. But I do think there's a bigger story here, which is that as India's weight in the global equity indices, the all-country world indices, is now exceeding 2%, truly global fund managers and people who allocate passively on a global basis now have to make an allocation towards India. And so that's a completely different feature of the market from what we've seen historically, where, as your previous question suggested, you're only really talking about India within the context of emerging market fund flows. It's now, for the first time, really a global equity destination.
Interesting that you say that. But do you think, Jonathan, at a time when there are not just EM funds, but like you said, global allocations also, which are upping up for India, are valuations for the overall market at all a concern, or any other domestic factors?
Well, from time to time, we've moderated our overweight when we thought that valuations were rich. At the moment, we don't have that view. We're around about 22 times forward PE for MSCI India. roughly the same multiple as the S&P 500. That may seem rich, but actually India's earnings growth is right up there with the best in the world. And a key point we also make about the Indian financial system at the moment is that bond yields are not volatile. 10-year yields are very well behaved and actually trending downwards in India. And equity market volatility is now well below the average in global equities. The systematic investment plans, the SIPs, and other domestic flows kind of drive that. It's just a very strong story. And as I said in the answer to the previous question, you're not going to buy a strong story like this on low valuations. The market won't be that kind to you to offer this on a low valuation.
Jonathan, if one looks at the risk for emerging markets, is it tariff? Is it valuations? What is the risk for emerging markets as we move from the first half of the year to the second half of the year?
There really is no such thing as emerging markets anymore. We've written about this really all the way back to our 2018 blue paper on multipolar world dynamics. We're just in a very different situation. We have the world's first and second largest economies, China and the US, in a period of intense hegemonic rivalry. We have a whole slew of countries in terms of GDP per capita ranges, macro balance, policy style settings. The old concept of some group of countries that were heading in the same direction, and you put the name on them as being emerging markets, it just doesn't work. If you were to think about emerging markets, then the strongest of them by far is India, for the reasons we've already gone through in this interview. We've tended not to be recommending allocating to emerging markets. It's rather to pick the strongest stories, which obviously include India.
You know, Jonathan, when it comes to India, the obvious choice and go-to space has always been the large financials, right? Other than that, because now the markets are also getting deeper, there's more money waiting on the sidelines, where else do you find opportunities within India?
I think branded consumer products and industrials are very important. And again, the modern urban lifestyle develops very rapidly here, and a very vibrant consumer scene exists. And a lot of those new transactions that you see, unfortunately, I can't talk about individual names, but they are taking place in this consumer area, which is of significant interest to us. So we're overweight essentially financials, industrials, and consumer discretionary.
Just to again go back to this entire piece of allocation, when you look at India positioning versus other markets, and when you look at the total flows which have been allocated to individual countries, would you say India positioning is still lower than the global MSCI benchmark, or we are right up there? I mean, what we are trying to perhaps understand and gauge from you is that, is there a lot of space left in the tank for it to get filled up further?
So India is our largest recommended overweight. It's been outperforming. Its share in the MSCI EM benchmark is continually rising, and also in the global equity benchmark that I mentioned. Within active dedicated EM funds, investors are around 150 basis points underweight, but they're not in the driving seat of price formation anymore. I mean, the market's changed completely. The SIPs, domestic flows, and now the arrival of the passive global flows and some active global flows, that's changed the market structure and dynamics. So I really don't think it's that significant where active dedicated EM managers are positioned. It's not of any great relevance.
Good having you on the show. Thanks as always for your time.
Thank you very much.
Okay, let's take a very quick break.
If you like this video, then like, share and subscribe to ET Now.